Hello all. In this short video, we are going to see some of the key considerations which are which we must be taking care of while purchasing any stocks. So these are related to their financials, valuations, market position, management, and the growth prospects the stock may be having, the company may be having. So let's start with the one. So financial performance. So these are the key matrices which we must be aware of. The first one is the net profit. So net profit, we know like what is the profit the company is making, and earning per share is like you have the profit, you divide by the how many outstanding shares are there, then you will be able to know the earnings per share. So they are both linked together. So that's where I have placed them together. This is the official definition. If we see here, net profit is a financial metrics that measures the company's profitability. Okay, and like we know, it is also called bottom line of a company. And net profit is usually reported on a share basis, also known as EPS, which is calculated by dividing the net profit by the number of outstanding shares of the company. The next one is the PE, price to earning. So this means that how much you are paying for 1 rupee of earning which you are making. So basically, it is the share price divided by the EPS. So if we see here, the price to earning is a financial ratio that compares a company's current stock price to its earning per share. Okay, so price, if you divide the price by the EPS, you will get the PE. And the higher P definitely means that people or the investors are willing to pay more money for the company, a company's stock. And this means that the investors have more confidence on the stock. Low PE means people are not willing to pay more money. And see, these matrices, when we see, we have to compare with the peers also. Meaning, let's say we are talking about bank stock HDFC, we should be comparing it against the PE of ICICI, for example. So then we get this thing factored out. So PE can vary depending on the industry. So it's important to compare the company's PE ratio to that of peers. So let's go to the next metrics, net cash flow. So how much cash is coming to the company? We know that it is the difference of inflow versus outflow over a period of time. So it should be positive. That's what is meant by cash flow. And now dividend yield. So please be very, very careful of the word dividend yield. Let's not say dividend is like 200% because that is on the face value of the share. So we have to see how much is the dividend yield, which means the dividend which is paid on the stock's current price, market price. Okay, so if you are getting, let's say, 4% dividend on a stock, and it's a very, very handsome dividend which you are getting, which means on the share price which you are paying, you are getting 4% every year. So that's what is dividend yield. It shows the percentage of company's current stock price that is paid out as dividends to the shareholders. It is calculated, I mean, calculation is easy, you can read it. So basically, it is the indicator of company's ability to generate income for investors and useful metric for investors looking for stock to provide a steady income. Now, please be aware, this also signifies a company which is paying a dividend uh, may be a company which does not have any growth plans. So they don't have any ambitions to grow. It can be thought of that also, that it is not having growth plans and it is not able to put that money to any other use, and that's where it is putting all the profits, it is distributing them as dividends. So which means that the growth of the company may be muted if it is giving a lot of dividends. So returns, we have two matrices, return on equity, return on capital employed, and the ROC is considered to be a better metrics, a superior metrics. So please consider that. And the ones which I have put at yellow, those are the things which we should be very careful of. So a 15% plus ROC is considered to be very, very good. Not for current year, it should be, you should be checking it for the last 10 years, probably. So ROE is basically returns on the equity. So If we read the official definition, ROE is the financial ratio that measures the profitability of the company in relation to the amount of equity invested by stakeholders. Okay, 50% plus ROE is too good. The ROCE is it is basically with respect to the whole of the capital which is employed. So ROE is only the equity, but there may be other capital like debt which the company has employed, and how much returns it is getting in the total employed capital. So that's where this metrics is more important. So we should be seeing the ROCE if in case we have to see some metric there. Okay, so ROCE. Then debt to equity, we know, I mean, it should be less than one for sure. So debt, how much debt the company has taken vis-a-vis its equity. So that's what is the debt to equity ratio. The debt to equity is used to evaluate the company's financial leverage, which means if it has taken a lot of debt, then it cannot grow. Basically, it is, and it cannot, the profits are basically, I mean, it may be going in paying the interest for the debt itself. Okay, so debt to equity is very important metrics to see to find out how much debt the company is having. Okay, so more than one is a strict no-no. Probably it should be less than one, but as less as possible, like a point 0.2, point 0.3, that can be a good thing to consider. Net profit margin, this is basically calculated by dividing net income by total revenue. Again, it's a very important metric. So a higher net profit margin indicates that the company is able to generate more profits after accounting for all its expenses. And the next one is sales growth. So we have to see whether it is able to grow the sales. So sales or revenue growth both means the same thing. So how much is the sale growing year on a year? That is what is the sales growth. 10% plus is good. That means company is able to um, uh, lead in the market segment where it is operating, and it is able to grow its sales. So profit is one thing, they are both related. The more the sales, the more the profit. I mean, it may not always happen so, but they are related. So it cannot be that you don't have any sales and you are having a lot of profit. That's not possible. So the sales growth. So the ones which are here highlighted in yellow, they are important matrices. But again, another thing is we have to compare them with the industry also. They cannot be seen in isolation. Uh, Okay, so this we already saw the sales growth. A company with a high sales growth is generally considered to be performing well and has a positive outlook. Okay, other company which is having a low sales growth, it may be struggling. That's what it means. Now, this is the second category which is there, which I have put here, which is the valuation. Now, one valuation technique which we use is a Graham number, which basically again Benjamin Graham had come up with the calculation for this, and it basically means that this is a fair price at which the stock should be trading. Generally, you will never see, at least in Nifty, you will not see a good share trading at its Graham number. So that's where I have not given it much importance also. So let's see. So Graham number is a valuation matrix developed by Benjamin Graham, and it is basically the upper limit of what a stock should be worth. Okay, so that's what is a Graham number. Still, it will give you some idea. If you see this number, you will be able to see how much fair the price of the share currently is. So that's where Graham number is going to help. This is price P versus the EPS growth. That is the PEG ratio. Okay, greater than one is overvalued, lower than one is considered undervalued. Okay, so this I already explained. Now, Piotrowski F score. It is basically Piotrowski. There are some variables which dictate this. This score can go from 0 to 9. And based on these different numbers, this score is being found, like profitability, leverage, liquidity, efficiency. Based on all these things, we get a score. And a score of 9 is meaning that the company has the strongest financial position. 0 indicates that it has a very weak financial position, which means that probably it's not able to utilize the assets it is having. Probably the debt is very high. Okay, so profitability is less. So all those things will lead to lower Petroskoi number. So this is also important metrics to see with respect to valuation. Now let's go to the next segment. This is market position and competitive landscape. So when we take any stock, if we do some market study, we'll be able to find the moat. Moat means the kind of market advantage or competitive advantage the stock is having. So that's basically very, very important. So this economic moat, like how exactly the company has been placed, how strong is the brand. For example, Pidilite, such a strong brand, or for that matter, Asian Paint, such a strong brand, ITC, such a strong brand with such a diverse portfolio. So this is one thing, brand, the intellectual IP rights which it may be having. For example, Google, so many patents. Okay, the network effects. Company's product is so valuable, everybody uses it. Switching cost. So if you are working with Google and you want to shift to some other, for example, Bing, there is no switching cost, but at least I mean everybody is aware. So switching cost is basically emotional here, wherein nobody wants to switch because of the kind of bond which is there. So switching costs could be like, for example, our infra. Another example could be like, let's say that we are already using some product, and if we have to change, for example, our power supplier. So the power supplier company which is working in our region, or a easy example could be a Wi-Fi provider. So if some other Wi-Fi provider we have to put, then we have to pay the installation charges. So this is a switching cost advantages. So basically government regulation or barriers to entry. For example, IEX. So very few players in the discom sector. So that's where they have a moat. Okay, so that's the competitive advantage which these shares are having. Let's go to the next one, very, very important, promoter holding. So if the promoters have sold out everything, then I mean, it's like nobody has their skin in the game. So that's where promoter holding is very, very important. And promoter holding refers to the percentage of company's share which is owned by the promoters. A low promoter holding may indicate the promoters have less control over the company and may not be invested in its success. Okay, so that's very, very important. All these text which is put here, it's very nice text, and I have put some time in placing it. You can pause the video and see the text, but I'll not read the text. Now let's go to the last thing, growth prospects. So, I mean, when we say growth prospects, we have to see how the prospects of that specific thing is. For example, EV. EV has a electric vehicle. Too much growth prospects are there, correct? So that's where, or IT industry, for example, or in India's case, the steel, because infra is developing like anything. So steel may be growing, anything related to infra, anything related to the banking, maybe a growing sector. So financial analysis, industrial analysis, competitive analysis, management analysis, market analysis, these are the various techniques by which we can know about the growth prospects of a company. And press release, and these prospects will it's not a static. Basically, it is important to note that growth prospects may change over time. So it is all these things, all these analysis we may have to do in a timely basis to know whether a leading company has gone down. Okay, it may be the best of the company, but its growth prospects may be muted now. So that's what is the growth prospects. So these are the five parameters, five buckets, which are very important when you consider purchasing any stock. Hope you liked it. Thank you very much. Uh, so I quickly wanted to discuss how we can see all these various matrices. So we can put our own ratios here, and all these ratios we can see here in the screener. This is a very good site. So just wanted to put this also in perspective, that you can use this screener to see the various ratios which are there for a company. You can see the some pros and cons. You can compare the PEs by doing the peer comparison here. You can see the quarterly results. Basically, you can see the revenue is growing. How it is growing, you can see from 31,000, it has become 45,000 in 3 years, let's say. Okay, so that's about it. It is able to give you a lot of details. EPS growth also it is able to give you. Okay, so lot of details it is able to give, and we are able to see the ROE also, ROCE also, balance sheet, everything here. So this is a good place where you can see all the ratios, the shareholding pattern. You can see that the promoters are holding like 25%, and it is like constant, almost constant. It's reduced by 1%, but more or less constant. So okay, good then. Thank you very much once more.